Hello and welcome. I'm Tushar Chande. Are you new to technical analysis and do you want to get better? You've come to the right place. You see all those indicators in that blue box? I've designed every single one of them and a whole lot more. So if you want to understand oscillators and understand how they work, yes, I can help you with that. So let's get started. But first, a quick detour. A reminder to please review my disclaimer. Remember that past performance is not necessarily indicative of future results. So let's continue. So what is an oscillator in technical analysis? First, an oscillator is usually based on price or on momentum. It's calculated on a fixed time length, say 14 days or 25 days. And thirdly, it has a fixed scale or axis. So in this case, we have Tesla prices in the lower panel and the Chande momentum oscillator in the upper panel. The oscillator has a fixed scale from -100 to +100 in this case, but the scale could be from 0 to 1, 0 to 100, or +1 to -1, or anything else you wish. Now, the zero axis is a midpoint in this case, and as prices evolve, the indicator fluctuates between the higher value and the low value, and therefore it appears to oscillate around the midpoint. And that's why it's called an oscillator. Here are the three common uses for oscillators. First, people look for divergences, that is difference in how the prices are behaving versus how the oscillator is behaving in order to anticipate a trend change. Second, they look to see when the oscillator has reached an extreme, and then we say it's overbought if there's been too much buying, that is prices have moved up a lot, or it's oversold, which means prices have moved down a lot. And just that might cause them to reverse. And thirdly, we can also use them to identify very strong or very weak trends. Simply speaking, just because the oscillator has reached an extreme, that doesn't mean that the market must now automatically and instantly reverse. In a trending market, the oscillator could remain overbought or oversold for a long period of time. So this is the formula for the stochastic oscillator invented by George Lane. Forget about the name, this is really a range location oscillator. So what this formula does is that it calculates the highest high and the lowest low, and therefore the range over say 14 days, and this is in the denominator. The numerator tells you how far the close is above the lowest low. So essentially it gives you the location of the close within that range. So if you look at the formula, if the close is equal to the lowest low, the numerator will be 0. That is, if the close is all the way down here, the value of the stochastic will be 0. Conversely, if the close is here, then we'd simply have highest high minus lowest low divided by highest high minus lowest low. So the value of the stochastic will be 100. So the stochastic oscillator is a range location oscillator. Now remember that the providers usually have different levels of smoothing in order to make the data smoother. So the smoothing can affect the values that you see. But overall, it's giving you a sense for where is the close located over the range of price action over the past few days. So this is a chart of the SPY or the S&P 500 ETF. The lower panel has prices. The upper panel is the stochastic oscillator. So if you look at this blue box, you'll see that the close is near the high end of the range. And so you'll see that the stochastic oscillator value is also near the high end of the range, closer to 100. In the red box, prices were falling, so the close is at the lower end of the range, and the value of the indicator is also at the low end of the range. The value has been smoothed by 3 days, so it gives you a smoother value. And the blue line is sort of a trigger line to help you recognize when the trend may be changing. So look at it when the price was rising steadily, the stochastic oscillator remained above 80 for some time, and we get the same impression here and here. So you can see that you can use the stochastic as a measure of trend persistence. But when the market is in a trading range, then of course we have changes in direction more rapidly. So that's why sometimes it's called overbought and oversold. So this is the same chart as the previous slide, but here I have drawn some trend lines here and there. So in this case, prices were higher here versus there, but the value of the stochastic oscillator was maybe slightly lower or about the same. So you could say that maybe it was flat over here, but rising over there. So we have a flat line compared to a rising trend line. So we have a divergence. Similarly here, if you look at the oscillator has been approximately flat, but if you look at the price behavior, the price made a lower low. So that's an example of a divergence. But now remember two things. First, the artifact of the calculation causes a divergence to occur. So if I change the time frame from say 14 days to 18 days, I may not see a divergence. And second, going back to the blue box and the red box from the previous slide, the width of the box is fixed by the calculation at say 14 days, but the height of the box is not specified. So even though you may have a same or similar value for the oscillator at 2 points in time or 2 different points in time, the size of the box that led into that value may not be the same. So in essence, you lose any idea about the amplitude of the price move when you look at the oscillator itself. So this is the same stochastic oscillator calculation as the previous slide, also with SPY data, but we've changed from daily data to weekly data, and you see that the picture looks quite different. I want to point out two things. During this uptrend, the stochastic oscillator was above 80 and stayed there, so the overbought nature didn't lead to a reversal, but just confirmed the persistence of a trend. On the other hand, here and here, the stochastic oscillator was oversold and it corresponded to significant lows in the market. We also have an oversold condition here, but of course it's not clear that we'll get a bounce in the market just because the indicator itself is oversold. So let's change gears with a different oscillator called the Relative Strength Index, or RSI, from Wells Wilder. The formula for the RSI uses 14 periods, and the numerator is the average upside momentum, and the denominator is the sum of the average upside momentum plus the average downside momentum. The momentum is first calculated by looking at the difference between today's close and yesterday's close. If it's positive, it goes on the up momentum side. If today's close is below yesterday's close, it goes on the down momentum side, and then they use an idiosyncratic moving average. So essentially, the RSI is the ratio of the up momentum to the total momentum. So if we have many upside days or large upside bars, we get an RSI closer to 100. And if we get a lot of downside momentum or large downside bars, then we'll get an RSI value closer to 0. So let's see how it looks like. So we are back to the SPY chart again, but this time with the RSI plotted in the upper panel. The scale is from 0 to 100. We've drawn lines at 70 and 30. So if you look at this part of the curve, when the S&P was clearly rallying, the RSI was able to rise above 70 briefly. Similarly here, when the market was selling off and we had big red bars or candles, the RSI fell below 30. So because the S&P is a big index with lots of stocks, it's very difficult to push it above 70 or below 30. And so people are fond of calling it as overbought or oversold. And just as you can have divergences on the stochastic oscillator charts, we can also use divergences in the RSI chart. So for example, here, roughly speaking, the RSI was making higher lows while the market itself was making lower lows. So that'd be an example of a divergence that you could use to anticipate trend changes. So this is a chart for Tesla where we still have the 14-day RSI in the upper panel, and I wanted to show you that it took a very, very strong move on the part of Tesla, a surge, an exponential move, to push the RSI above 70 and even above 75 or 80 and keep it there. So the RSI calculation, because it uses some idiosyncratic moving averages, is really hard to push above 70. And it takes an extraordinary move in the underlying instrument to do that. Now here's the same Tesla chart as the previous slide, but now we've changed the RSI calculation from 14 days to 100 days. And now you see the problem with the RSI. You see that the value is stuck between 70 and 30, and it's almost impossible, quote, to get it to go above 70 or below 30. So essentially, we cannot use very long time intervals with the RSI. So that gives us a chance to talk about another of my indicators, which is very, very popular. It's called the stochRSI or Stochastic RSI. So it combines the momentum concepts and calculations from the RSI with the range location concept from the stochastic oscillator. So we're asking, where is the RSI value within its range over the last X days? And this approach is very useful when we want to use lengths more than 14 days. So let's go back to the Tesla slide with the 100 bar RSI now in the uppermost panel and compare that to the 100-day stochastic RSI in the middle panel. The scale is 0 to 1 for the stochastic RSI, and we have lines at 0.8 and 0.2. Now you see that in this portion, when Tesla was surging, but the 100-day RSI was well below 70, the stochastic RSI rose above 0.8 and stayed there very nicely, showing us that the momentum was increasing dramatically. Remember, this is momentum of the RSI, i.e. the stochastic of the RSI, and not the range location of the close of Tesla within its 100-day range. So we're measuring momentum directly, but we're looking where is the momentum as calculated by the RSI approach within the range of the momentum over the last 100 days. And as this market surged, as Tesla surged, we see that the momentum has also surged, and momentum is near the high end of the scale and close to 1, meaning it was peaking as the Tesla was surging. So this is an example of how you can combine different concepts, and the stochastic RSI is extremely popular and powerful. During this downtrend here, you see that the stochastic RSI was below 0.2, and then during the surge here, we just got a little bump, but it was occurring at the end of a downtrend and so on. So this is another powerful oscillator with a fixed scale that measures how strong is the momentum within its own range for momentum values. So we are back to the Tesla chart, but in the upper panel now we have the Chande Trend Meter, which behaves like an oscillator because it has a fixed scale from 0 to 100 with lines at 80 and 20 and 90 and 10, but the internal calculations are completely different and combines many different types of indicators and time intervals to give you a composite idea of what's happening to the trend. And again, if you focus on this surge as we've been talking about, see the CTM went above 90 and stayed there during the strongest portion of the trend. So that's again an illustration of how you can take multiple indicators and put them together into a single indicator on a fixed scale to create an oscillator that's more powerful than just the traditional oscillators. So we're coming to the end of the slide deck. I just want to remind you that if you want, you should check out the Tushar Chande's complete toolkit for Metastock, which has many different powerful indicators, including the Stochastic RSI, the CMO, and the Chande Trend Meter, and systems as well. And you can find information about it at metastock.com/Chande. I also have a package for NinjaTrader, which includes my UltraFlex moving average, an adaptive price channel, a bunch of short-term and long-term oscillators, and accelerating exits if you want some innovative ideas on trading breakouts more aggressively. Thank you again for watching all the way through the end. If you wish, you can check out my blog at chandeindicators.substack.com. I hope I'll see you soon. Until then, goodbye.